Welcome to today's deep dive. We're looking at a stack of research today on how major economic data prints, things like inflation or jobs reports, move global markets in like a matter of seconds.
Yeah, it is wild how fast it happens.
Right. So the mission here is to decode why markets react the way they do, just to help you cut through the noise of those confusing financial headlines. Because, trying to trade the news feels a bit like trying to guess the weight of a cow at a fair, but with a twist. The prize doesn't go to whoever guesses the real weight. It goes to whoever guesses what everyone else wrote down.
Exactly. Which completely explains the chaos you see around these releases, right? A headline drops, the market rallies. Next month, the exact same headline drops, and, well, everything just tanks.
Yeah, that's what always gets me.
Because the market isn't reacting to the data itself. It's reacting to the spread between the actual number and, the consensus estimate that institutional algorithms have already priced in.
Okay, wait, let's pause there, because this is where the logic feels totally broken to me. Say I read a headline that employment is just booming. If more people have jobs, shouldn't corporate earnings go up? Like, why does the market treat strong economic data like a toxic asset just because it beats some consensus estimate?
Well, you're looking at the economy, but the institutional traders are looking at the central bank. So if we are in a high inflation environment, a massively strong non-farm payrolls report tells the market that the economy is running way too hot.
Ah, I see.
Yeah, so the central bank is going to stay hawkish, keep interest rates elevated to force a cool down.
Right, and higher borrowing costs ultimately crush corporate profit margins, even if top-line revenue is up. So the good news for the broader economy basically becomes terrible news for equities.
Exactly. That dynamic doesn't last forever, though. The absolute hardest part of trading these releases is that the rule book just expires. What drove a massive market move 6 months ago might not even matter today.
Because the overarching macroeconomic regime has shifted.
Spot on. The reaction function changes based on whatever the current regime is.
So it's kind of like a moving spotlight on a stage.
Yeah.
If inflation is the market's primary nightmare, the consumer price index dominates that spotlight.
Yeah.
Every single tick is scrutinized. But if the fear shifts toward a recession,
the spotlight swings immediately away from inflation. Traders suddenly care about growth stalling, so they start looking at payrolls, consumer spending, and PMIs.
Purchasing Managers' Indices.
Right, exactly. PMIs are essentially surveys asking factory managers if they are buying more or less raw material this month. It's a real-time pulse on future production. So when recession fears peak, a bad PMI read will crater the market faster than almost any other metric.
Okay, so if the spotlight is always moving, how do you, as an everyday investor, avoid getting caught off guard? It seems like just reading the headline is the fastest way to lose money.
Oh, it absolutely is. A major trap is treating a single release as the final verdict. Traders will see this massive headline beat and just blindly jump in, completely ignoring data revisions.
Oh, because governments rush out those initial prints based on incomplete survey data.
Right, they just do it to meet publishing deadlines.
Okay.
The real finalized numbers actually take months to calculate. So a supposedly booming jobs number this month might actually hide massive downward revisions for the previous 2 months.
Wow. So the initial headline is practically a mirage.
Often, yes. And trading that mirage is incredibly dangerous because of how market mechanics work in those first few seconds. When data drops, liquidity instantly dries up.
Because the big market makers step back.
Yeah, they don't want to get run over by a rogue number.
Yeah.
And because they pull their orders, the spreads, the gap between the buying and selling prices widen drastically. You end up paying a massive premium just to enter a trade.
So what does this all mean for you listening? Is the real edge sometimes just sitting on your hands and waiting for the initial wave of volatility to pass?
100%. Patience is a trading skill. It is not a missed chance. Let the algorithms fight over the initial frenzy. The clearer setup usually emerges after the dust settles. Selective participation.
Makes sense. Selective participation beats constantly reacting. These economic indicators provide a framework to read the market's current priorities. They aren't some shortcut to easy trades, but they are a way to understand what the smart money is actually worried about.
Yeah, it really all comes down to pricing in the future.
Which leaves a pretty wild question for you to consider. If financial markets are entirely driven by trying to anticipate these economic releases, what happens to market volatility when predictive AI models eventually learn to forecast these data prints perfectly, like long before the government even publishes them?
That is the billion-dollar question.
Right. Will there even be a reaction, or will the game just end before the opening bell? Something to think about.